Hi, everyone. Welcome again to another podcast with Ted and I. The purpose of this podcast is to help everyone become financially savvy and be able to make great decisions, whether you're an investor, someone who's looking to do business with some of these companies, or even if you're an interview. Now, don't forget to like, share, subscribe. We have a bunch of videos for you to look at with some great companies, and you'll be notified as soon as we publish them. So today we're going to be looking at a very large business indeed, a company called TUI, and they are based in Germany. They are a tourism business. Now, just a little bit of information about this company. This is the largest tourism business in the world, and they have 1,600 travel agencies, 6 airlines where they have about 150 aircrafts, 300 hotels, and 15 cruise lines. So very asset heavy business, but they have a lot of reach. Now, for those of you who are fans of our channels, you will think, well, this is very similar in some respects to a previous company we looked at called Thomas Cook. Now, Thomas Cook is a British-based business, and as a lot of you may know, they went bust. However, even though a lot of people said, well, we couldn't have foreseen that, how could anyone realize? Actually, we found out that you could if you had looked at the financial statements and known what to look for. So it'd be really interesting to see what we found out. So stick around if you want to find out how this business has fared and whether they're going to fare during the COVID pandemic and what their finances are showing about that. Stick around. We're going to show you exactly that. Now, this company came in as a recommendation. So thank you again to Liam. We have so many of you viewers recommending companies to us. Thank you very much. And again, as always, we are happy to oblige. So this is for you, sir. So Ted, what have we found out? Let's see how this business might fare during the pandemic. And do they look at risk like Thomas Cook, or have they been able to make some changes and maneuver themselves out of this?
So good to see you, Moeed. Thank you very much. And yeah, let's have a look at TUI. So let's dive straight in. Here are their financial statements, the financial report for 2020. Now, there's a lot of information in here, and we've got to go all the way down to page 144 to actually find the financial numbers. So a lot of this information is about the board of directors. It's a very big board of directors, and the corporate governance and the structure and the remuneration, etc., etc., etc. But it takes us a while to get down to the consolidated financial statements, page 144. Now, we find out on page 144, let's zoom into their income statement, and the first thing we notice, which is no surprise, Moeed, is that at the very top, their sales have fallen from 19 billion, that's 1,000 million euros, down to about 8 billion, okay? So as a result of the pandemic, this company has seen its top line halve in value. And as we'd expect, the cost of sales has come down as well, because if you don't sell a holiday, you don't have to buy a holiday. However, they will have bought lots of holidays that they then had to refund, but they couldn't get out of their contracts. And so the cost of sales has not come down as much. And they've moved from a 1.4 billion profit to a 2 billion loss. Okay, so they got a gross loss at that top line, which is not good on a trading account, okay? And that's really as a result of the pandemic. We see the overheads have actually gone up a little bit as a result of the as a result of the business. I'm not sure exactly what's going on there. And they've also seen this big increase in other income, which has really helped them out. So they have moved, bottom line, from a profit of €500 million to a loss of about 3 billion. So a very significant bottom line. Okay. Just the other thing to notice when we're looking at these numbers, just jumps out at me, is the financial expenses gone from 171 million to 322 million. Okay, and that tells me that this company has probably taken out more debt. We will find out whether we're correct in that when we look at the balance sheet. Right, so here we are looking at the balance sheet. So here are the key numbers. Let's see what we can find out. So the non-current assets, these are the things we need to run the business. We can see that the big numbers here are goodwill. Now, if you remember, that appeared on Thomas Cook as well. This is a company that has grown. It's a very big company, but it's grown by buying other travel companies. And as we'd expect, the goodwill will appear as a result of that. They've got a lot of property, plant and equipment. It's fallen since last year, so significantly down, not a lot of investment going on. And also this right of use of assets. Now, this isn't, they haven't gone out and bought 3 billion during a pandemic. That's merely an accounting adjustment, so they actually have to account for it. And what we'll see is that there's a liability associated with that. This is lease assets. So if you've bought a computer outright, it would already be in property, plant and equipment. But if you were leasing your computer last year, it didn't appear on your balance sheet. And this year it does because of the change in the accounting standards. So we don't have to worry too much about that. And the rest of it, there's a little bit of joint ventures and associates, and the rest of it is pretty small fry. No inventories, of course, because they don't hold stock. They book holidays. And we can see here, this is a key line. They started the year with 1.7 billion euros in cash, and they finished with 1.2 billion in cash. So they've got a lot of cash. They've held that cash, and that's been allowing them to kind of survive this pandemic. Let's look at the other side of the balance sheet, which is the liabilities. So in terms of the liabilities, here are the current liabilities down the bottom. Let's just move that down a bit. There we go. So we can see our current liabilities down the bottom. Very high current liabilities and very high compared with the current assets. And this is actually a feature, if you remember, of travel companies. So even in the previous year, we had they had 4 billion of assets versus 6 billion of liabilities, and that's partly because of their business model. So what they're doing is that they're selling the holidays. They take the payment up front, the people go on holiday, and then they pay the tour operator and the hotel. So they got very, very strong cash flow as a result. Even so, to drop down to 2.7 billion versus 5.9 billion is, it's making me a little bit nervous. Okay, there's only so close to the wind that you can actually sail here. So these guys have got, so you can see the trade payables aren't suffering too much. They've come down. Again, we'd expect them to fall because, there's less holidays, so there's less hotel operators who need to be paid. So we're not sure whether they are still funding, whether they're using those trade payables to fund them. I would doubt it. You'll notice here, there's the lease liabilities. So we mentioned that before, that those lease liabilities effectively, that contras to this number here, which was the right of use asset. So all they've done is taken the assets and what they owe on the leases and put them on both sides of the balance sheet. So the net effect is relatively small. And so that leaves us on to the equity, which is up the top. So let me just scroll this down a little bit so we can see the equity. Oh, by the way, on financial liabilities, of course, we want to have a look at this one here. So we can see the debt has increased. So as we'd expected, we thought the debt would have increased. You remember the interest has gone up, and so the debt has increased. So it looks to me like they've been funding themselves. They've been funding themselves by raising debt. And you'll notice that the capital hasn't really changed. So the share capital, the investment by the shareholders, they haven't gone to their shareholders and said, we need more to issue more shares in order to survive the pandemic. What they've done is they've taken on more debt. Now, that's quite interesting. So that's quite a punchy move. So rather than diluting existing shareholders, they said, we'll take on more debt. We can afford it. And when things come back, we can either pay down the debt immediately, or we will pay it down over the future. What we do notice here, though, is as a result of all this, is that their balance sheet has been hammered in terms of the equity. So they've gone from having 4 billion in equity down to 200 million in equity. So the balance sheet has effectively been completely annihilated, and we can see the revenue reserves, that's the retained profit and loss, has gone down significantly. They're actually sitting on a loss to begin with, a retained loss to begin with, but it's gone down even more since. So let's have a look at their cash flow statement and see what's going on there. Oh, interestingly enough, in fact, just before we get to our cash flow statement, this is the movement in changes of equity during the year. This is last year, and you'll notice that they actually pay a dividend in 2019. Well, that sounds fine to me, because 2019 everything was tickety-boo. But what's quite interesting is that in 2020, or rather during from September 2019, you'll notice that there's also a similar payment going on. So they've paid another dividend. So even though they're in the pandemic, they're making a loss, they're maintaining a dividend to their shareholders. They're committed to their shareholders, and they are confident that when the thing comes back, when the pandemic is over, the V-shaped recovery, they're going to be cleaning up. People have got savings, they want to go on holiday. These guys are going to be delivering for it. They're going to survive. They borrowed some extra cash in order to tie themselves over for this this short period. Looking at the cash flow, so traditionally very strong cash flows, making $1 billion in cash, and of course, as a result of the pandemic, they've basically taken a massive hit and seen that their cash has gone down from operating activities by 2.8 billion. Okay, but it's temporary, it's one-off. It wasn't there in 2019, and these guys are pretty confident it's not going to be there in 2020. So cash from investing, they've stopped investing. So last year, that you can see they were investing. This year they've stopped investing. They've been divesting. They've sold some assets, some companies. They've hunkered down. They've kind of said, these bits and pieces we don't need. Let's just get rid of them. Raise a bit of cash from there, and then they've got a positive cash flow from their investing activities, which is effectively where they have been issuing debt or borrowing money, so raising money by borrowing additional cash effectively, and that is effectively what has tied them over. So that's the kind of the key numbers coming out of there. And as we said, their working capital looks very, very low to me. I'm a little bit nervous. The equity has been wiped out, but these guys, I think, I don't think that they're going to luff up. I don't think that they're going to go to the wall on this. And I think that they potentially are very well positioned for a strong bounce back. Okay, so here is their share price. It's been falling and it's been bouncing around. So this is sort of 2018. So it has been ticking up recently. It has been starting to push up. Now, what's quite interesting here is that when we look at the market cap, for example, market capitalization is 4.8 billion. Now, we can't do a PE ratio because there is no earnings, so that becomes irrelevant. So all we can do is we can look at this on a kind of inherent goodwill. And don't forget, we told you that the balance sheet had been annihilated and was only worth 200 million. So why would you pay 4.8 billion for a company that's only worth, on a net asset basis, about 200 million? Well, what's really interesting about this is ignore the price to earnings for this year. Think about what's going to be next year. And if you don't know what it's going to be next year, then why don't we look at last year? Last year, they earned $500 million net profit. Well, back of an envelope calculation, if it's $500 million net profit and it costs you 4.8 billion to buy it, they're trading at about 9 times earnings. Now, 9 times earnings, I think, is pretty cheap. So it looks to me like these guys, there's a lot of good news out there. I'm not convinced it's fully reflected in the price. And I think that this may be trading at lower in the market than it should be. It looks like it's going to take a bit of time. There's still nervousness out there. We're 2021 right now. The pandemic hasn't been completely finished. There's still, corridors and amber lists and red lists and all this kind of stuff. It's going to take time. These guys, I think, will survive. I don't think they're going to do a Thomas Cook. That's my personal opinion, not my advice. I don't think they're going to do a Thomas Cook. I think that they are well poised to clean up. There's going to be a lot of people out there who've got savings who are going to want to go on holiday. These guys are going to be taking them there. They dominate the market. If there are struggling players who've got really nice client lists, they can snap them up at an absolute discount, at a bargain basement, and plug them into the TUI machine. They look pretty good to me.
Yeah, that's interesting. I think that's the first time we've come across a company that we felt could be, in our opinion, a potentially good buy for when things get better. So that was very interesting because the strength is in their numbers. Can they survive long enough for the good times to come back again? And it looks like they have at least the financial power to be able to do so. Who knows what might happen in the future? Of course, we don't have a crystal ball machine to predict that, but it looks like they could be making it. And it might be a good buy, in our opinion, as maybe if you dip your toe in the waters here. So this was a very, very interesting one. And don't forget, to all of our viewers, right? We are experienced at looking at these things, but when it comes to investment, we're looking at it from just the financial perspective, which is the fundamentals. There are a whole host of other things that you've got to do your research on. We're not here to give you the video that will tell you all the answers so that you do no research. You've got to do some research at other areas to identify whether this is a great investment or not. But we are giving you something that a lot of people actually, funnily enough, don't look at in a lot of detail. And it's absolutely fundamental to do so. So this was a great video. Thank you again to our viewer for recommending this and asking us to actually look into this. I hope that it was useful. We would love to hear your thoughts. So leave a comment in the comment section. If you're an expert in the industry, we'd love to hear your thoughts as well. Share it with the community. And if you want us to if you want us to analyze another video, leave a comment as well. So like, share, subscribe. Ted, this was fantastic. And everyone, until the next video, we'll see you soon.